Hey, James, you there?
I am here, Rod.
Okay, some technical difficulties.
19 minutes. Well, yes, 19 minutes late from when the webinar was, I guess, advertised as starting, but you and I both had it in our calendars as a 1 o'clock start. So for us, we're 41 minutes early, but go figure. We'll get it right, and we apologize to everyone who's been sitting around waiting for us to begin.
And more importantly, James, I assume you're going to be recording this, so for those who have to leave early, they certainly can.
That's correct.
Okay, and it looks like, James, do you see my, because I some technical, do you see my presentation view or do you see my PowerPoint view?
I see your presentation. I see the slide, but I can definitely work off this.
Okay, let me, we can work off, I think what we need to do is, let me try this. Let me know if this is better. That was probably
works.
Much better, I would think. Yep, that works much
works.
better. Okay. So let's apologize, James. Let's get started. But before we do, to everyone, there is a couple of things, ways you can ask questions. Number one, there's a chat box you'll see on the upper right corner, is a little dashboard-looking feature, and there's a chat, C-H-A-T, chat box there. You want to ask some questions. We'll absolutely get to everyone's questions in regards to today's presentations, and you can ask away in that chat box, and we'll get those responses to you. Otherwise, James, I think we're ready to go, and I'm going to ask you to introduce yourself for those that are on the line. But my name is Rod Santomassimo. I'm the president and founder of the Massimo Group. We're the industry leader in commercial real estate coaching and consulting within the brokerage, mortgage, and property management community. And I'm thrilled to co-host this session this quarter with James Nelson, partner of Massey Knakal. James, can you give yourself a brief introduction, and let's get started.
Sure thing, Rod, and thanks again, as always, for hosting. Just to give everyone a quick reminder of Massey Knakal, who we are and what we do. We cover the New York metro area. We now have 4 offices, Manhattan, Brooklyn, Queens, in New Jersey, handling investment sales, retail leasing, and capital services for the entire New York metro area. So I know a lot of you out there think of me as just the New York City investment sales guy, but if you ever have a need or a question, if you're looking to sell a property up in Westchester, you're looking to finance a property in New Jersey, you're looking to lease some retail in Queens, that's something that you can always come to me with, and our company is set up to do that.
Okay, James, well, let's get started. We talked about the New York market after the first quarter. We looked back at the growth after the second quarter. We're now 3 quarters into 2014. And the overall review, what's going on?
So we are still on pace for a record year this year. The summer did slow down a little bit for closings, but traditionally we've always seen the fourth quarter be the most active, and so if that continues true to form, I think we will end up with a record number of sales. Maybe not a total record for total dollar sales, but an impressive year nonetheless.
Okay, so we're looking at continued growth, and I know we want to look at a couple of areas of New York, but let's talk about the city overall. And right now, you can say we're continuing to grow. Values are soaring, in your words. So give us some more particulars about what's going on right now in the New York City market.
Right, so what we're looking at on this chart is third quarter of 14, annualizing that and comparing it to 2013. So if you can see, that dollar volume, and we're on pace right now to do about $52 billion in sales for all of, and when we talk about New York City, just to clarify for everyone, we're talking Manhattan, Brooklyn, Queens, and the Bronx. These are all sales of 4 families and up. So we're talking apartment buildings, development sites, retail, hotel, office, basically every food group. And we're on pace to do about $52 billion in sales, which is a 36% increase from 2013, but still a bit off our forecast, which would have made us on par with 2007's record year. So we'll talk a little bit later of why that is. But look at the number of sales there. Up 30%, the pace to do about 5,100 sales this year, which would be an all-time record, or at least as long as we've tracked over the last 25 years. Average price per property, very solid, citywide at over $10 million. Average price per square foot in Manhattan for all different asset classes now over $1,600 a foot for the last quarter. That's an average this year of $1,303 a foot. But we do not take into consideration that record-breaking sale at 737 Madison Avenue. That was the Chanel retail condo that traded for $31,000 a foot. That is, we believe, a record not only for New York City but for around the world. Very impressive stats also for the boroughs. Average price per square foot up 11% from last year. Average price per square foot, no shocker here, up 26% throughout New York City. This is whenever you see a report where it's all green as opposed to red, it's showing that we're getting improvement across the board compared to last year.
Okay, I think what you may have misquoted. I think what you meant the average price per buildable square foot. I guess that's from a development standpoint. Is that correct, James?
Yes, yes, that's correct. Thank you.
Okay,
yes,
perfect. Okay, let's break this down a little bit because there's some detail behind these numbers, obviously. But let's look at dollar volume and where we are compared to 2013. What we're projecting. What's going to happen here?
Right. So the last, the peak in '07, there was $62 billion in sales, 90% drop in 2009. We remember that. That was not a lot of fun, but we've been basically doubling every year, since then, 2010, 2011, until finally it started to kind of even off and get some consistency in 2012 and 2013. But right now, on pace to do about $52 billion in sales, which is going to be about 10 or 11 billion shy of the forecast. And if you look back in '07. Not only was there close to a dozen billion-dollar transactions in '07, but that equity office, that Blackstone sale where Harry Macklowe was the beneficiary of the bulk of that portfolio at $7 billion. I mean, that was a lot of that dollar volume in '07. This year, we have not seen as many billion-dollar plus transactions. You can count them on one hand right now, but we're going to get some help in that it was just announced, I don't know if you all saw last week, that the Waldorf Astoria will sell for close to $2 billion, $1.95 billion to a Chinese group. So, again, if we have a traditional busy fourth quarter, we still could end up eclipsing that 2007 record.
Oh, okay, so dollar volume's up, so that only suggests me certainly that property sales is up as well. You alluded to that earlier in your second slide. Is that accurate where we are today?
Absolutely, and here this is a lot more stable, where when you're talking about the total number of sales, you're not as dependent on the billion-dollar mega trades, and here we're getting a lot of help from the boroughs. So we're going to see on the next slide why we're on pace to set an all-time record for the number of properties sold in New York City.
Well, what I find interesting about this slide, James, is I recall 2012, especially the fourth quarter, people were really rushing as far as getting those assets sold and the fear of the capital gains hike. So you're saying we're even going to surpass that record level that we've seen in the last 6 or 7 years?
That's correct.
Okay, incredible. Okay, so you talked about the outer boroughs driving sales. It's not just the inner Manhattan. So give us a flavor of what's going on in the outer boroughs.
Absolutely. So you can see since in the last 10 years, Manhattan has been pretty consistent. There's always plus or minus about 1,000 sales. Now, Manhattan only accounts for about 17 or 18% of all the buildings in New York City. It's only about 25,000 properties, whereas when you go to Brooklyn and Queens, each of those boroughs have 75,000 properties. So what happens is, if you really want to have an increased number of sales citywide, you really kind of rely more on the outer markets, the boroughs. So look at this graph and look at what the outer boroughs are doing, and that peak in the last year or two is really what's driving us to over 5,000 sales this year.
Incredible. Just incredible. The activity is going on not just in Manhattan. So let's talk about activity again, New York City-wide. So just looking at New York City over all the boroughs. So there's been some fluctuation, but we're seeing a slight uptick in per price property?
Absolutely, and this is pretty remarkable given the last slide that we're showing that more and more sales are happening in the boroughs because on average the properties that sell in the boroughs are a lower dollar amount. So the fact that not only are we having more and more sales in the boroughs, in fact the stat that we had that was not in here is that Manhattan this year has accounted for only about 18% of the sales in New York City. So if 82% of those trades are happening in the boroughs, and again at smaller dollar figures, it's still pretty remarkable that we're holding at an average of over $10 million per sale in New York City this year.
It is. When you think about the fluctuation, the diversification in the boroughs, and let's look at the boroughs within Manhattan itself, and then this diversification. Let's break it down from regards to appreciation. Not all boroughs are, I guess, created equal. Is that a fair statement?
That's correct, and not even each neighborhood is created equally. And you know, this slide I find the most interesting, and when we really look at, you know, what have values done from 13 to 2014, and Manhattan leading the charge with a 24% increase by price per square foot. Northern Manhattan also heavy trading, especially in the multifamily segment, so very strong performance there. But look at Brooklyn. I think that would probably surprise most on this call, where they would say, well, look, we understand that Manhattan has boosted values 24%, but I bet if you took a poll of this audience, they'd probably think that Brooklyn has had greater price appreciation than Northern Manhattan. So what I asked our research department to do, because they said, you know, that 14%, that really is an average of the entire borough. So I said, I wonder if you just kind of drew a line and kind of split the borough in half, and if we talked about what's happening with price appreciation downtown, you know, we're talking Williamsburg, where I've heard that retail on Bedford Street, we're handling a development site out there where the pricing is now reaching $3,000 a buildable foot. I mean, that's on par with what we're seeing in Manhattan. So I think if you looked at that growth in Brooklyn, closest into Manhattan, I think you'd see a much more dramatic increase. Meanwhile, Queens has been very stable. That's a borough that traditionally we have not seen a lot of trading in, a lot of long-term owners who are long-term holders, and we saw that Queens did not drop as much as the other boroughs during the correction, but has not you know, has had as much of an uptick as well. Meanwhile, the Bronx, and I talked to Carl Brumback from our company who sits in the Bronx office. I said, well, first of all, you know, $157 a foot, that sounds like the value play right now. If you're looking for cheap bricks in New York City, you really got to look at like the value proposition that the Bronx has. But I said, well, why, when the rest of the city pricing is going up, why did the Bronx drop, or why is it staying flat? Carl's take on this was that investors are taking over riskier and riskier propositions in the Bronx. They're going further out. There's a lot more trading in the South Bronx, and as a result, when you look at that average, again, that South Bronx is going to bring down the pricing average of kind of the more established northern Bronx neighborhoods, maybe closer to the hospital and the Norwood section, which are some very nice blocks up there. But the South Bronx, again, this is where a lot of the trading's happening, and as a result, the stats might not give you a full picture of what's taking place there.
Okay, so a lot of velocity, a lot of deals, appreciation, especially one year over another, but it's not all 1 year we're talking about. If we break this down to since our recovery period, 2009, 2010, there has been different appreciation based on location geography. Tell us a little bit about that.
Right. So what our research department did here, and I had to ask them twice about this because I'm not used to speaking in indexes, but as they were kind enough to explain to me, 100 is the base case. That's where the price was in 2009, and that's where we're comparing pricing from 2009 to the first 3 quarters. So if you look at Manhattan up there around 80%, okay, what that means is that pricing in Manhattan per square foot from 2009 to the first 3 quarters of this year has gone up 80%. That's pretty remarkable. And then you see Northern Manhattan next in the lead, and then Brooklyn in the middle. But again, Queens and Bronx, the pricing has been very stable. And you can actually see Queens was one of the only boroughs that actually did not really dip in 2010, but really has not moved much. So if you look at the pricing difference between Manhattan and Queens, Queens has, only gone up about 12% since 2009. So I think it's very interesting. I mean, if you're a long-term holder, areas like Queens that might not bounce as high up or down, I think it's interesting. But clearly, if you were buying property in 2009, you would have served a lot better by investing in Manhattan.
Now, history can sometimes, forecast the future. But not saying that's the case yet, but we're saying since the recovery that the appreciation delta, the difference between Manhattan and Queens, is some 62 basis points. That's pretty remarkable.
It is. Rod, do you want to ask our callers if they have any questions? I know they have the ability to type in if they want, and I know we're a little pressed for time today, which is why we're kind of racing through this, but we usually get a lot of great questions. So if people do want to type into the chat box and put your questions to Rod, he's happy, and I can field questions as we go along.
And James, also there's a question and answer box that you'll see on your dashboard, James, that I do not have privy to as a presenter. So you may see some questions as well. But I'll save up some chats, and what I'm going to do is get through there, and the ones that hit hard I'm going to ask you about as well. And I've been commenting on some of the questions that are coming up as well as answering those questions. So
great, and I do have a question here of if there's if we can send out a PDF of the presentation. Happy to do that. Thank you for asking. And then I am already getting the B question, the bubble question. Rod, we should start.
Not yet.
We should start tracking when. Oh, you knew about that question. You've been saving to ask me that towards the end, or should I try to tackle that now?
We'll tackle at the end. That's a question that always comes up. And when things start to go really well, and this chart suggests they're going very well and growing, when's the bubble going to hit? That's always the question that comes up. But let's go to another B word. And if you didn't like indexes, you're certainly not going to like bifurcation. So, James?
Now we're getting really fancy right here. Now we're getting
really fancy.
Bifurcating our indexes. Is that the plural of index? I don't know.
There you go.
So what's interesting here is that elevator apartment buildings have shown the most growth. Looking at that, I mean, over 210% price appreciation since 2009. And I think what we're really seeing is a lot of these Class A apartment buildings. I mean, we're seeing examples. We sold an elevator, a brand new construction elevated apartment building last year in the Gowanus. There we were close to $1,000 a foot. So you kind of look at what this new product looks like, and we're hearing a lot of stories recently where developers are saying, look, rather than condo this and sell off units and pay ordinary income tax and P.S. take a year and a half to complete the sellouts, I'd rather just sell it as an apartment building. I'll rent it up, and that way I can 1031 the proceeds and go buy something else. So from a tax perspective, it makes a lot of sense. But from a value perspective, if you're selling a Class A rental apartment building for over $1,000 a foot, we're talking about on a net basis, you'd have to sell condos at $1,200, $1,300 a foot. So if you're in the boroughs, that certainly makes a lot of sense. We're even seeing a lot of forward sales, and this is something in my 16-year career that I have not seen a lot of, but I'm now getting requests from developers saying, hey, James, if I am in mid-construction with an apartment building, can I sell my building now? And the answer is yes. And we've seen a recent example of that in Brooklyn on Union Street where a buyer put down a deposit which was predicated on a TCO being issued and a certain amount of units being rented out at a certain rate, and was possible to facilitate that. So that's why I think, when you look at these Class A elevated apartment buildings, why there's been such a spike. Retail, we're going to talk a little bit about this later, but clearly the run-up in retail values, rents have been a big example there. This chart would make you ask the question, are office building sales on the decline as far as value? We would say quite the opposite. What we're seeing is that now there's been so much demand for office that we're seeing a lot of Class B and Class C office buildings trade, which traditionally sell at far less than new construction. And then you see walk-ups and mixed use kind of chugging along. But again, the most dramatic price increase across the various asset classes have been in that elevator, apartment building, and retail space.
Okay, and you mentioned selling some assets mid-development. You mentioned some new development issues with Class B, Class A. So let's talk about development. Let's talk about buildable square footage. What's the trend here today?
So the trend, and it's always tough to get an average across the board, across the city, because you hear 240 a buildable foot. That doesn't seem that impressive when we're talking about Manhattan sales that are over 1,000 a foot. But you have to remember, there's still land that you can buy out there. Certainly in the Bronx, affordable land at $30, $40 a buildable. Further out in Brooklyn, seeing trades under $100 a buildable foot. So, but if you look at just an average and the fact that from 12, even from 12 to 14, there's been a big increase and really double since 2009 is pretty remarkable. But you look at that chart there, and Manhattan, again, only 17% of the buildings in New York City accounts for 21% of all development site sales. Still a lot of development going on here, and certainly in Brooklyn as well.
Okay, and with all development going on, the values continue to be enhanced. No doubt cap rates continue to be compressed.
Correct.
And so from a cap rate compression standpoint, look at this chart on the right, James. What is that stack? What should we take away from this capital stack?
Well, what we're looking at is the average cap rates by borough, and clearly the lower cap rate means that investors are willing to accept less of a return for more, the hope would be more future upside, more stability, better located real estate. But at 3.6%, the average cap in Manhattan, that is pretty unbelievable. That's right on par with effectively where you can borrow money today. But the average throughout the city is 5.5%, and looking at Queens and Bronx, again, 6-7% returns. If you're a buyer looking for cash flow, that's really the place to be right now.
Okay,
but again, massive compression. I was just going to say since 2009. I mean, it's hard to believe that the average cap in 2009 was 7%, but I still remember some office building trades happening then. So pretty remarkable that the cap rate compression has if the net operating income stayed exactly the same from 2009 to 14, the value of the property just by the cap rate compression alone would double. Citywide, and then of course you have the fact that the rents have been on an enormous upswing since then.
Okay, so the obvious question is, James, wait a minute, 3.6%, I can go get some financing or I can get an investment for that same return. So why buy in Manhattan now? That's the question that's going to be hit hard. And we're going to talk about Manhattan in specific and more detail in the next few slides, but as we're setting that up, why Manhattan? Why would someone invest in Manhattan today?
Right. I think many would make the case that, first of all, it's the most blue chip investment. You've got so much foreign investment, although some of that now is starting to look at Brooklyn, but Manhattan is always going to be the most liquid. But I think you're also best positioned in some cases to have huge run-ups in value. Certainly, I think it'd be tough to make the case today that that's going to happen as a result of further cap rate compression, but I think as we see some of the slides later on with some of the retail rent increases over the years, residential condo increases, I think the feeling is Manhattan has always had the most potential upside where it can have huge gains, but Brooklyn is making a very strong case for that now with some comparable rental and condo growth.
Okay, perfect. And James, this is a good segue. We're going to now move to Manhattan. We're going to focus on Manhattan itself. So far, everything we've discussed has been New York City overall, comparing the boroughs, but I know from the audience by a good number of folks here are focused on the Manhattan marketplace. So, to no surprise, you mentioned earlier with the entire New York City marketplace, volume is up. But give us some examples of this volume and some transactions we're seeing in Manhattan this year.
Right, so the dollar volume in Manhattan is up 33%. So when we talk about an anticipated $52 billion in sales this year, $38 billion of that has come so far. We're anticipating will come from Manhattan alone. And here we are seeing some of the larger trades. Nothing from this quarter in the billion-dollar range, but Park Avenue Tower, partial interest, 95% trading. for $750 million. That's valuing the office building at $1,275 a foot. And we have started to see some office building trades at over $2,000 a foot. We're going to talk a little bit later how that has happened. 212 to 222 Broadway. $500 million, that's about $660 a foot, and then 683 Fifth Avenue, the office building. We're going to talk a little bit later about that, but an impressive trade there as well at $460 million or $3,400 a foot.
So these are some rather large transactions, and one would think, well, that must, does that skew the average? But it looks like, based on the data we shared prior, that prices continue to increase, and the average price for the asset in Manhattan, I think the number you gave me was some 1,700 assets. I believe you suggested, James, maybe 17% of the last. I'm sorry. The average price per asset continues to climb as well.
That's absolutely right.
So when I look at this average price per asset, over $40 million, we haven't seen that since we won't even use the term, that phase in real estate pre-2008. So we're really bouncing back well.
Absolutely. And I think that number is only poised to increase, certainly as we see larger trades that we anticipate. I mean, when you start averaging in a couple trades like the Waldorf Astoria at close to $2 billion, I mean, that makes a big, big difference. And, 06 and 07, I mean, there was a lot of those billion-dollar trades, and that's why you see the average at $42, $52 million.
Okay. And, the chats come in as you see these trends. People think of B words again. We'll get to that. We'll get to your thoughts about that, James. But let's continue with these soaring prices. If the average property is, and I guess that's an improved asset, James. So does that include development? Let's talk about development properties. Certainly talk about trends. Development's the hot topic, it seems, today.
Absolutely. I mean, we were saying earlier this year that because we were handling and witnessing a lot of these residential development sites selling for $800-900 a buildable foot. I remember we sold a corner site down on 10th Avenue in Chelsea at $850 a buildable. That was 2 years ago, and people are saying, wow, that's an incredible number. And, at the time we said, well, look, if this is a site like this is combined with great retail, we should start seeing numbers north of 1,000 a buildable, and that we're clearly seeing. So 719 7th Avenue sold at over $1,400 a buildable foot. West 57th Street, $1,200 a buildable for $95 million. This last property at 985 89 3rd Avenue, we were actually involved in this sale at $1,100 a buildable. This was actually part of an assemblage. But you look at that average, going from the last 5 years at 382 a buildable up to about 657, but just headed, looks like that's not even at a, I was trying to figure out what kind of degrees that is. It's almost pointed exactly straight up, but looking at the difference between the first quarter of 11 and this last quarter, I mean, the pricing has increased about 2.5 times for land in this short period.
Okay, so development is hot. So if development's hot, then somebody asked the question, what kind of property types are in flavor, or certainly how they're appreciating? So as we move to the next slide, James, it looks like, yes, value continues to appreciate in Manhattan specifically, but also different property assets have different value appreciation. So share with us a little more about this chart on the right-hand side.
Sure. Well, one of the biggest drivers of values in Manhattan and New York City, for that matter, has really been retail. And you look at that average retail number, even without that Chanel trade, still $34.54 an average per square foot. So, I mean, just kind of using back of the envelope here, if you're valuing your retail on average at a 5 cap, that would suggest the average retail rent is roughly about $175 a foot. So we even talked about extreme examples like Fifth Avenue near Rockefeller Plaza. If they're getting rents of $3,000 a foot and you were to sell that at a 5 cap, that would suggest that retail could be worth $60,000 a foot. And we've been talking about this for the last year. And that Chanel trade at $30,000 a foot, I mean, there you could say the retail is probably in the low to mid thousands a foot. So I think we have yet to see, if we see a prime trade like that for a solely retail asset on Fifth Avenue in the Plaza District there, very possible that could go even beyond. But just across the board, remarkable $34.54 per foot. That even includes side streets where clearly you're not getting $175 foot rent. But the average, year to date at $1,300 a foot for all property types, mixed use, including some of that retail, which is making it the second highest. And then walk-ups still slightly higher than elevated apartment buildings on average per square foot. And that, again, is because we typically see that the average rents in a walk-up building are going to be higher than an elevator because there's a lot more turnover there. And office, again, we talked a little bit about that before, but for the Class A new construction, we're seeing over $2,000 a foot in some instances, certainly if there's good retail, but you mix in some of the Class B and C office buildings that are trading, you see a lot of those comps at $500, $600 a foot. And if you're looking for value today, I would be a buyer of office product down in the Wall Street area. You see some of those trades down there. Chase Manhattan Plaza, that was a $300 and $400 a foot trade. Now, granted, there was a ton of risk involved with that because once they leave, there's going to be a lot of vacancy. But the Chinese group Fosun bought that. And I think if you're talking about buying office product or anything for that matter in New York City for $300 to $400 a foot, that is definitely a value proposition, certainly if you have a long-term investment horizon.
Okay. Wow, a lot of great information there. It's amazing how in touch with the marketplace you are, James. I'm always so impressed, so thank you for sharing. But let's get to my favorite slide. I'm not supposed to have a favorite slide. I recognize that, but I do. I do have a favorite slide and a favorite story, and I want to talk about a specific transaction. I want you to share and really break down, as far as an investment, just one you see in the marketplace, and we're going to focus on this 683rd Fifth Avenue. Can you share what's going on behind that transaction?
Sure thing. And if you really like this slide this much, Rod, just for you, I will blow it up for poster size so you can feature it in your maybe hanging up above your fireplace at home. The interesting thing here is you look at a building like this, and you got 21,000 square feet being the retail. This is on the corner of Fifth Avenue, and you've got Diesel down below, and then you've got the office building, which is controlled by Gucci. So the square footage for the retail is only 17% of the entire about 135,000 square feet, but you've got about half the income. So when you talk about why this building sold for $460 million, which was $3,427 a foot, how did that happen? You look at that retail value, and the retail alone, if it's blending at $515 a foot over 21,000 feet, you've got $10 million of income coming just from that ground floor. So what is corner retail on Fifth Avenue with Diesel? What is that trade for? I mean, that could easily be, four cap territory. So that's really supplying over half the value of this transaction, we believe. And, I mean, if you really broke out that, if you applied that four cap, you're talking about roughly $12,000 a foot in value. So not that makes the office space upstairs quote-unquote affordable, but that really shows how you get to that blend of $3,400, because if you apply $12,000 a foot of value to the ground floor, you're really just buying the above floors in the thousands per foot.
Incredible. Incredible. You look at that asset, you look at the purchase price, and you break it down to fully understand it. Okay, so we all know the adage.
I'll just add two more kind of bullets for similar type trades if you're keeping score. 450 Park Avenue was a $546 million sale at $1,632 a foot. Again, really retail driven. And then 650 Madison Avenue, there's been a lot of talk about that, $1.3 billion. That was $2,155 per foot, again, because of the retail.
retail. So let's focus. Let's continue our discussion on retail. And if real estate is location, 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 certainly no more is true than for retail assets. So based on the location, based on the valuation, share with us what's going on the retail side.
Right. So here we're looking at the increase from 12, and Rebney provided this, but look at the average rent now on Fifth Avenue in the 50s, $3,500 a foot. That's a 29% increase. So impressive, but from a rent increase growth, Broadway and 7th Avenue, Times Square, that's really been the story, as well as 34th Street between 5th and 7th. Average rent now almost $900 a foot, a 58% increase. I asked our research department, I said, how come Soho's not on this? Because when you look at really prime retail quarters, you want to see what kind of increase they're having. Soho, the average now is $890 a foot. That's a 62% increase. So again, very impressive rents on Fifth Avenue, but the question is how much, if they're already getting $35.50 per foot, how much higher can you go? And you know, I'm not a retail specialist to say whether or not a business can actually make money at that level, or if that's really, I think a big part of that is really the advertising and being able to plant a flag there. But again, what value does someone put in that, and how much more growth is there? I mean, could someone, could a store on Fifth Avenue rent for $5,000 a foot? I guess it remains to be seen.
Absolutely incredible, and this has been some incredible information. We got a lot of questions, and James, I'm sure you probably have questions on your question and answer panel. I have some from the chat panel, and the only thing we have left, folks, because I want to be observant of your time. We did start late, but I know you probably had it at 1 o'clock, so I want to get to some questions, then we're going to wrap this up with a recap of everything, James, if that's fair.
Sure.
Question came out.
Okay. Well, I had a quick one, which was why was the mixed-use pricing flat? So again, we were looking at that index. We talked about how elevators and office buildings pricing soared, but you know, and retail. But why did mixed use? And again, mixed use includes a retail component. Sorry, it was the next one, Rod. I think it was slide number 12. Why was mixed use? Why didn't that spike? That's a great question. You know, my gut, and I have to do the, you know, ask our research to really look into it, but I think when you talk about mixed use, oftentimes you're talking about residential up top and retail on the bottom. Usually if there's residential up top, there's probably a greater chance that it's going to be on a side street, whereas you look at some of these straight retail, straight office, I mean, those are just on, you know, typically on the avenues, those Class A elevated apartment buildings. Again, we talked about why the pricing was there, but I think the mixed use, I think what you're talking about is probably averaging in a lot of the side street product, which could be kind of keeping that that value on the lower side. But you know, there's definitely clear examples of mixed use buildings that have spiked in value as a result of their retail. It's just not reflected here in the average.
Okay, perfect. Other hot button, James, seems to be, you referred to this a couple of times with different entities buying different assets, the international or foreign influence. How much of an impact do they have on current transactions in New York City and even Manhattan?
Right. So, and we should include this slide for our fourth quarter year-end wrap-up. But Real Capital Analytics has tracked $10 billion in foreign investment to date in New York City, $3 billion of that coming from China. So it has been dramatic. I think it's been a major, major driver in the price uptick. And it's really interesting because I've spoken to a couple different people about the foreign interest, and you know, do we think it's a positive? Does it continue to fuel pricing? And on one hand, I spoke to one investor who said, look, you know, foreign investors is not sticky money. In other words, New York City is the safe haven right now. It's been the fundamentals are very strong. But if something were ever to happen, or there was another city elsewhere in the world that was more attractive, you know, does that money stick around? And his whole point was, and this was a long-term New York City operator who said, look, we're not going anywhere. We've been buying properties over the last 100 years, but a lot of these foreign investors, it's a different country every year. And I don't know if I agree with that because, again, we're seeing interest from countries across the board. I wouldn't say there's anyone out there who's not making large investments in New York. But I think from a positive and a more glass half full approach on this is that, I was speaking to a Chinese developer, and he was saying, look, you haven't even seen the tip of the iceberg. There is so much money looking to invest in New York. We're just finding ways to do it. The Chinese government just came out with a report that they're now going to release governmental approvals and purchases over $100 million. We'll see what that's all about. But, I mean, look, you've got so much foreign capital. Norges, which is the Norwegian pension fund, the size of that fund alone is $60 billion, and they're looking to, deploy, they said, 10% of that in the U.S. So, that pension fund alone could account for 10% of our sales. So I think what it keeps coming down to is there's a lot of foreign appetite, not enough product, and if anything, I think what's going to happen is other cities in the U.S. are going to benefit. I heard a nice presentation from one of the economists out there, and they were talking about how Seattle has actually jumped in the last 5 years. They weren't even a top 10 U.S. market, and now they're top 5, and they said that a lot of it had to do with some of the institutional capital that was displaced from New York. In other words, that because we couldn't accommodate all the interest, it's ending up in other cities around the U.S.
Well, that's incredible. It's incredible, number one, the impact that the foreign markets, China specifically, have had in New York. It's also, I say, equally incredible the encyclopedic knowledge that you certainly control regarding the landscape of real estate. So let's get to a couple of key questions here. You mentioned South Bronx, North Bronx. You mentioned Soho. Last time in our presentation, we talked about Hudson Yards. Is there a hot pocket? You mentioned, downtown, Wall Street office. Is there a hot pocket right now trending, or hot pockets in this New York City landscape?
I always like to look for disconnects in value. So, and that can even get very micro. It can be block by block. So I like Wall Street on the whole because I think that it's, when you look at its average pricing compared to the average, its office buildings only sell for about half or a third of where you would sell elsewhere. So I think that's really interesting, especially with everything that's going on with the World Trade Center, and not to mention its transportation. But I think there's other neighborhoods. If you look at NoHo, for example, and you look at rents in Broadway, it's exceptional what's happened in Soho. The average is now $8.90 a foot. But if you go a couple blocks north onto Broadway, you see that the average rents there are $2.50 a foot or less. So, the question is, do the rents drop off? The rents drop off by a third from Soho. Now, does the foot traffic drop off by a third? I don't think so. So I think what's happening is that, a lot of investors are kind of focused on Soho because it's Soho, but if you look at kind of the economics, I think that just using that as a comparison, I think NoHo is undervalued. I also think looking at the West 40s and 50s, some of these neighborhoods that are next to Hudson Yards that are going to benefit from all this infrastructure are really interesting. And I think if you look at their sales prices, I think you're going to see that they're trading to a discount, certainly to the south from Chelsea and the Village. So again, I think it's finding neighborhoods where there's a disconnect, where the values are a lot less than maybe, they're neighborhoods that are adjacent to them.
Okay, let's continue with the trends, and so the questions are coming in that, James, what is the crystal ball? Someone as knowledgeable as you, and you don't have to mention the B word, but those questions are coming in. But what's the crystal ball? And let's keep it short term for now. Remaining for 2014, 2015. What are you saying?
So, the interest rates are always, come into focus when we talk about the next year or two. And our head of capital services, Gareth Thelander, just said, look, the global economy is so fragile today that for us to increase our interest rates would have a a very negative impact. And so a lot are now projecting that these interest rates are going to stay where they are over the next year. If that's the case, we should be in a very good pocket as far as pricing. Also, talking about some of the other, around the world, some of these other markets. I mean, Europe has yet to recover, still having challenges, a lot of instability as you look across the world, and as a result, New York continues, and the U.S. continues to be a safe haven. So I think from a macro standpoint, we are still looking very good for the next year or two. I try not to go much further out from there. But the if you want to talk about just kind of supply and demand, because I know a lot of the concern, and when people talk about the bubble, they talk about the fact that there's all these cranes out there, a lot of new apartments being built, and people are saying, well, how many of these luxury buyers are actually going to show up? The reality is that in 2009, 2010, there was about 11,000 apartments on the market in Manhattan. Today, there's only about 5,000. So, the point is that there's a lot less product on the market today. These developments are a lot better capitalized because people are coming in with a lot more equity. And even on the office side, there's not speculative office being built. You look at what's happening in Hudson Yards. They're building as tenants sign on. Same with the World Trade Center for the most part. So, I don't mean to be Pollyanna about this, but again, I think the fundamentals look very strong. And with this foreign demand and with this interest rates, pocket that we're in, I think for the next year or so or two, I'll even go out that far, I think we're looking like we're on very stable ground.
Okay, James. Why don't you do us all a favor? Let's wrap this up. I know from the time, and I appreciate those and it seems like everyone has stayed on, so I appreciate that very much. James, I know there's 3 major points to come out of this presentation. I know it's not my favorite slide. It was too much reading for you and I, but go ahead and give us a macro view of, wrap this up, what we discussed today.
Sure. So again, we are talking about a record number of sales which will take place this year at over 5,100 properties. That's over 30% more than last year. We're talking about total dollar volume, which could still reach that $63 billion. We'll definitely see about that. Pricing per square foot, as you remember, was up in all categories. The average, now at $1,300 a foot in Manhattan, which is up 24% from last year. And in the boroughs, $290 per foot was the last quarter, up 11%. Land, we talked about that huge 2.5 times increase since 2011, pretty remarkable. And let's see, I didn't read down this slide, but I think we covered the bulk of price, volume, and the various asset classes.
Okay, that was absolutely phenomenal, James. I can't thank you enough for sharing your insights and your knowledge to what's going on in the New York City commercial real estate landscape and the trends and the hot pockets and everything else. I want to share the information with our audience of yours so they can reach out to you. I also want to share with everyone else that we are, in fact, recording this session. You will get a copy of the recording of this session by registering for this webinar. I want to thank you particularly for your time and your interest in regards to the status of the New York City commercial real estate space. James, any final comments?
No, I think it should be very exciting to see how things wrap up for the year. Again, traditionally, fourth quarter is usually the busiest one, and we're already on a record-breaking pace. So it should be very exciting to report back to you all in mid-January after we've finished up our numbers and hopefully have more good news to report.
Well, thank you, James, and thank you, everyone. I wish you the best of days and have a great fourth quarter. Take care.
Thank you.